Investing success relies much more on patience and discipline than return on investment. It also can require some pain and sacrifice. Yet despite all of this, we often focus so much more on trying to predict what our returns will be and predict future events that might impact those returns. Instead, we need to focus much more on our behavior and our emotions, because that's going to lead to investing success. In this video, we're going to discuss investing behaviors you should avoid if you want to be a successful investor. But before we do, make sure to hit the subscribe button. I want to make sure that you don't miss any of my videos on investing and personal finance. Let's get right into it. Don't let overconfidence derail your future investment decisions. Let's say you've picked a few stocks recently and they've all increased in value over the past few months. Your perceived success in picking these stocks may be less attributable to you and more attributable to other factors. Was it really your wisdom and stock picking prowess that led to those returns? Or was it due to a rising market or other factors beyond your control? You want to be careful that you don't get too overconfident based on some of your past successful investing decisions. Hindsight bias is another behavior trait that can lead to poor investment decision making. There's an old expression that hindsight is always 20/20. Hindsight bias is believing that unpredictable past events in retrospect were actually obvious and predictable. This is a very serious problem that a lot of investors face, and it prevents them from making good, sound investment decisions. The real estate bust, the mortgage meltdown, and the financial crisis of the last decade can serve as an example of hindsight bias. While granted, there were a few people who saw these crises coming and took action to either profit from it or try to warn others. But it wasn't until after the crisis was over and we look back with hindsight that everything becomes so clear. The problem with this is that then leads to the idea that everything that happened then is probably going to happen now or into the future. So there were lots of people who saw that crisis and saw the severity of it, and once things started to recover, never believed that things could recover and assumed that we would just go right back to where we were before. Obviously, that didn't happen. That's not to say that there aren't going to be future crises around the corner or in the near future, but just because something happened before and it becomes obvious to you now doesn't mean the same thing is going to happen in the future. Another investing behavior that should be avoided is short-term focus. If you're focusing too much on short-term events, either in the news or in the financial markets, you run the risk of dramatically impacting the future success of your investment portfolio. If you're a long-term investor, the reality is that it doesn't really matter what happens in the news or in the markets today, tomorrow, next week, next month, or even next year. If you have a long-term investment objective, the rest of the short-term stuff that comes along is just noise. And if you react to it, you're going to find that you're going to be reacting to every short-term event that comes along, and you're going to be bouncing all over the place. So if you're a long-term investor, it's best to stay focused on the long term and not worry so much about what's happening in the short term. Now, if you're a trader, that's fine. You're going to be focusing on the daily news by the minute, what's happening, getting in and out of stocks on a regular basis. But it's important to note that trading is not the same thing as investing. And I'm not suggesting that traders are bad or doing it wrong. Just important to know that trading is not the same thing as investing. So if you want to have a good shot at investing success, I recommend keeping an eye on the short-term focus and making sure that you don't react to short-term events. If you're suffering from hindsight bias, short-term focus, and overconfidence, don't worry, there is hope. But if left untreated, These feelings can lead to lackluster performance, falling short of goals, and a lackluster retirement. Make sure that you avoid these investing behaviors for success in investing in the long term. If this video was helpful, please make sure to hit the like button, and most importantly, be sure to subscribe. I really appreciate your support.